Warren Buffett, in his letter to shareholders Saturday, said his company Berkshire Hathaway enjoyed a $29 billion gain from the recent change to the tax code, bemoaned the lack of good deals for acquisitions and reminded investors that owning a low-cost basket of stocks through index funds is the best way to build wealth over time. In 2017, Berkshire's net worth grew $65.3 billion, boosting its per-share book value by 23%, according to the letter. Buffett noted, however, that only $36 billion came from Berkshire's operations. The remaining $29 billion was delivered to us in December when Congress rewrote the U.S. tax code, he explained in the letter. The new law cut the corporate income tax rate to 21% from 35%. Book value, Buffett's favorite measure of value, is the total amount a company would be worth if it liquidated its assets and paid back all its liabilities. Over the past 53 years, Berkshire has grown its per-share book value at a 19.1% rate compounded annually. Buffett's yearly check-in with Berkshire Hathaway investors through his investment letter is a closely watched event on Wall Street. He is among the world's best investors, and his insights and nuggets of wisdom on the economy and financial markets, as well as his investment advice, are always in demand. Investors looking for more details on succession planning at Berkshire, however, got no fresh insights in the letter. In January, Buffett, 87, narrowed down a list of people who could replace him to two in-house Berkshire executives, Greg Abel and Ajit Jain. Both men were named vice chairman. At the end of his letter, Buffett again reiterated that Berkshire will be in good hands after his eventual departure. "You and I are lucky to have Ajit and Greg working for us," Buffett wrote. "Each has been with Berkshire for decades, and Berkshire's blood flows through their veins. The character of each man matches his talents. And that says it all." Buffett, in his folksy, investor-friendly writing style, addressed topics ranging from the overpriced market for mergers and acquisitions to his disdain for Wall Street's high investment fees. He also shared his time-tested investment advice that favors stocks over bonds over the long term. Buffett also let investors know why Berkshire, which is now sitting on a record $116 billion in cash, didn't pull the trigger on any mega deals last year. He says he was turned off by high asking prices for businesses he considered buying. The biggest thing missing from the deals Buffett's company Berkshire Hathaway reviewed last year was one of the key qualities the billionaire looks for when buying a standalone company: a sensible purchase price. That requirement proved a barrier to virtually all deals we reviewed in 2017, as prices for decent, but far from spectacular, businesses hit an all-time high, Buffett noted in his letter. Indeed, price seemed almost irrelevant to an army of optimistic purchasers. All that cash earning little to nothing is a drag on the conglomerate's earnings power, analysts say. Buffett's company, Berkshire Hathaway, has a broad financial reach that extends to virtually every part of the economy. It owns an array of blue-chip stocks currently valued at over $170 billion, excluding shares of Kraft Heinz. Equity holdings include Apple, Wells Fargo and Coca-Cola. Berkshire also owns scores of businesses that it has acquired over the years, including auto insurer Geico, ice cream retailer Dairy Queen and BNSF Railway Company. Last year was another good one for Berkshire shareholders, as the company's shares rose nearly 22%, versus a gain of 19.4% for the S&P 500. A broad stock market index. Berkshire's shares also became the first stock ever to reach a price of $300,000. The conglomerate's major money-making business is its insurance operations, which in addition to Geico, includes a sizable property and casualty business as well as Berkshire Hathaway Reinsurance Group and General Re, another reinsurer. A reinsurer is an insurance company that insures the risks of other insurance companies.